Good morning and welcome to BQ Prime. We are looking at the markets, the recent developments, the volatility, and the inflows and outflows, and the outlook in the short term, medium term, and the long term, and more importantly, the news that came out yesterday from the RBI trying to curb what we call it the loan party, the personal loan party, which was creating risks in the system. Who better to talk to about what is the pulse of the market than Mr. Unmesh Sharma of HDFC Securities? Unmesh, welcome to BQ Prime.
No, thank you. Thanks for having me.
Okay, so Unmesh, my first question to you is, how would you assess the current state of the market? One day it sounds bullish, one day it sounds uncertain. You have conflicting cues coming from the global scenario. What's your overall assessment of the current market situation?
No, I think your question itself kind of seems to suggest that when you say that it's positive one day and negative one day, it's actually the third, which is that there is a lot of uncertainty. So what ends up happening in this situation is that either people sit back and try to look through this, which is what long-term investors do. The other is, which is what it seems to be the mood of the market currently, is to pick up on any cues which come up in the short term and kind of react accordingly. So if you see the way in which the market has reacted recently to the inflation print in the US, for example, and suddenly everything's become risk off, rather risk on, and risk off is off the table. I think that's what's happening. I think it's a sign that there is a lot of lack of clarity on what will happen in the next 6 to 12 months, and which is why every single data point is being seen as a pivot to to the market moving in another direction. So to a large extent, whether you look at global macro or whether you look at local, I think uncertainty is basically what is ruling right now.
Right. So that's the day-to-day movement and volatility that one is looking at. If I look at it from the flow perspective, how do you look at the FI flows versus the domestic flows? Domestic flows are very clear. We know mutual funds, people are putting a lot of money. We keep getting about 15 to 16,000 crore every month after month through SIP. So that's an assured money coming into the market. But FIs are coming in, going out. What's your assessment on that front?
Yeah, so you make an interesting point. So what's happened is that actually earlier, when I started my career, it used to be FIs used to be a little bit more stable, while the domestic flows used to come in and out. Now you will see that with this theme of financial inclusion and market participation, the inflows on the domestic side are a lot more stable, which is what is showing up in the performance on the small mid cap funds as well. The FPIs is where the problem is in terms of lack of a lot of clarity as to which way the flows will go. If you start top down, if you look at the bond yields in the US today, you can get AAA paper there in the 6 handle. And very often, I would think myself that if there is a global asset allocator, they would think, why not just invest in AAA assets in the US rather than taking country risk, currency risk, and so many other things to invest in EMs. So what's happened is that every time there is a change in view as to what happens on yields over there, for example, what happened in the last few days with the inflation print, or for that matter, whether the economy is slowing down or not, there seems to be a lot of volatility. And what happens is, because the pool of capital is so large, that every time there is a small change in view, it's like a butterfly which creates a thunderstorm somewhere else. That someone moves 100 basis points from debt to equity, or reverses from equity to debt. What you find is that it actually has a huge impact on the relatively smaller markets such as India. So on the FPI side, I think at this moment in time, the way we are looking at it is that on the global macro, I still think that we seem to have got ahead of ourselves in the last few days. The higher for longer theme is here to stay, which means that FPI flows moving from equity to debt, that theme will continue. Within that, yes, in the short term, we have some, for emerging markets, especially India, we have some relief from oil prices, but there is also uncertainty because of what's happening in the Middle East. And on top of that is the uncertainty regarding the election. So we believe what will end up happening is that you will continue to see volatility of FPI flows. But I believe till the time the dust settles on these global macro factors and some sort of certainty on what happens in the central election, outlook on that settling down, we believe that market flows will continue to remain volatile, which is usually not a very positive sign from the FPI side.
Right. Okay. So let me get down to specifics. Till the markets closed yesterday, the mood was different. After 5:30, after the evening coffee, the governor fired the first salvo. He has tightened this reckless lending to personal finance consumers, personal consumer loans has been tightened. Now, this has changed the texture of the banking industry, the policy. How do you view it? Suddenly this has come. It's been time. It's been over time that the RBI has been warning and telling banks to take the foot off the pedal, but they didn't. Now they have to come up with this sweeping measures. What's your assessment?
Okay, so look, this is firstly not unprecedented. In fact, if you go back to the big, growth cycle of 2004 to 2008, at that point in time, towards the end of that cycle, Governor Y.V. Reddy at that point in time used to pick up individual sectors like infra and specifically, I remember, real estate, and consistently kept increasing the provisioning norms as well as the capital adequacy weightages, risk weightages for capital adequacy. In India, it's not like we haven't seen this before. Whenever this, however, happens, it's always the timing which surprises people, which is what happened in our case as well, and which is what is showing up in the market reaction as well. The question here becomes as to whether this was coming or not. The answer is that there are pockets of companies which on media as well as in the earnings call had started to talk about the fact that on the personal lending space, there has been, especially on the personal loans, unsecured or mostly unsecured, the quasi-unsecured loans, there is some stress which could build up because of the high growth rates. Now, if I elaborate, in every asset cycle that we've seen in the last 20-25 years, there will always be this one pocket where the understanding of credit, in hindsight, of course, is not the best. So it could have been the small private sector banks, could have been the PSU banks. In another cycle, it was the NBFCs. In another cycle, it was the mutual funds. And then, in this cycle, it could be the fintechs. Now, what is the RBI trying to say here? One is that it is not so much about the action itself, because the governor has gone on record saying this in the past already. Okay, so why this measure was required is because I believe that the data which is available to the Reserve Bank, which is much more than what we as analysts would have, or for that matter, what they themselves had in the previous cycles, may indicate that they are worried. I think much more than the mathematical impact on what happens to the credit cards businesses and what happens to personal is the strong signaling factor that is being sent out that on the consumer loans, they can foresee a problem coming and hence things need to slow down. We believe it's a nice prudent measure to be able to do that. I think eventually the stronger lenders with better credit practices are not affected by this. But in the short term, obviously, everyone will have to suffer the pain of the higher provisioning that will be required for all of this.
Right. So as part of your equity strategy, how would you fit banks or Bank Nifty, if I can use that basket, or NBFCs into your strategy now, given the current situation? And I can foresee some amount of increase in spending because of elections, wedding seasons, etc. That's in the short term. How would you view banks now?
See, this is a slightly simpler question, thankfully, because it has banks have multiple levers now at this moment in time. One is the technical matter of the fact that if you see the portfolios of the FPIs, they were always more in the liquid stocks, which is where the banks and the consumer names were there. So, technically, I think they seem to be a bit oversold because of the fact that the FPIs have been exiting and the domestic retail has not really offset that completely in the large banks. So financials as a whole, we like in any case. Okay, in our model portfolio, we do have an overweight stance on the financials as a whole. Now, however, obviously, that is not to say that you can have a broad brush impact on all of this.
Sure.
The way we have always, in any case, viewed is the HDFC Securities style is a lot more value. It's a lot more, bottom up. What we have overweights are the large private sector banks. Luckily, if you see after what's happened with FPI selling and domestic buying, is that there seems to have. We believe that there is more value in the large caps in any case as a basket, and within that, on the banks, it's the most stark. So I can't talk about my parent organization, but because I work for HDFC, but at the same point in time, if you look at our largest overweights are ICICI Bank, Axis Bank, State Bank. Amongst the second tier, because that's not what you can fill your portfolio with. We have out of benchmark positions in City Union, Bandhan, and the way we complete the whole basket is by going out of the non-lenders into things like insurance, market infrastructure, which is kind of financial. So, if you look at the exchanges, for example, so that's the way we are playing this. On as a whole basket, financials we are overweight, and we believe that I in fact believe that it's quite a no-brainer that if you're creating a large portfolio,
sure,
that large banks, private banks should find a space in there as an overweight.
Right. So within the financials, the housing segment, it's a very strong and it's a growing segment after HDFC's merger with HDFC Bank. Now that space, there is a view that space is vacated. It could be other pure play housing finance companies that would come into play. From a medium to long term perspective, how do you view, let's say, an LIC housing or PNB housing or any other housing finance company for that matter?
Okay, so I'll have to answer that slightly differently. I believe that, look, there are two things. One is I can't talk beyond a point about HDFC Bank, but at the same point in time, there are two spaces when you look at NBFCs. One is the space in the market in terms of the market share, and the other is from the financing perspective. As to what market share of the money which is available in the open market, non-deposit taking kind of market, corporate side is available. Okay, on the market side, I see no reason why a merger between HDFC and HDFC Bank should change anything for anything, everything on record. You could say that their presence remains on the ground the same as what it is, but I can't say anything beyond this.
Understood.
And if you look at so on that front, I don't think things are changing.
Sure.
And that's not the view that our housing finance report, which is written by Krishnan, our analyst, says at all, that there is going to be any change in that sense materially in terms of market share on the ground presence. What, however, on the lending side is that given that the largest borrower in the non-deposit taking market is off the market, so as to speak, because it's now become a deposit taking bank, is there more space available for money to reach companies like LIC Housing Finance, for example, or PNB, or for that matter, the whole chain of NBFCs doing housing finance? The answer is that yes, there is a material impact there. Having said that, do we have any of those very specific names in our model portfolio? The answer is no.
Okay.
But we do have some positive views on that. Yeah.
Right. Okay. So that leads me to the next question related to housing, real estate. Real estate, there is kind of a boom. I don't know whether it's a bubble. You would be better placed to answer that one. How do you view a real estate run? The run has been continuous and there is still a lot of optimism left in the market. What's your view?
Yeah, no, so we are quite positive on the real estate space. In fact, in our model portfolio, real estate actually in the index is not there. So we have taken a fairly strong out of benchmark 250 basis point kind of position in SOBA in our model portfolio, but more broadly, not just being stock specific. We've run the real estate overweight for over a year now. We are quite comfortable holding that. The run-up actually does not scare us. The reason is because if you look at the real estate cycle, unlike the other stocks, it tends to be a two-layered cycle. There is a cycle in real estate itself, which tends to be a decadal one. It tends to go beyond the stock market cycle, which is 2 to 3 years, because it's gone through the doldrums for a long period of time. I think the real estate cycle bottom in the previous cycle was when RERA got introduced, and as a result of all the cleanup which has happened in financing, in terms of reporting, in terms of unorganized to organized shifts, all of that benefit is starting to show up now. Income levels have gone up. COVID is over. There is a strong theme of residential upgradation, so on and so forth. If you look at the 10-year cycle, I think that is intact. Now, while the price increase may scare you, what however happens is that in a real estate cycle, if you look at the last 10-year cycle, what you will notice is that the increase in volumes is only the first stage. There is then the stabilization and then the price increase which comes through. And do note that the earnings, or for that matter, the NAVs of the real estate companies and valuations are a lot more sensitive to the price increases. We haven't seen that yet. And then there will be a euphoric phase. We are in a positive phase. We are not there yet. I believe that this rally from a long-term perspective on the underlying real estate has a lot of legs. And on top of that are the stocks. So there seems to be, yes, of course, stocks have gone up, but at the same point in time, for great quality companies which are in a position to continuously be able to raise capital, either by pre-sales or through the debt and equity markets, to be able to grow, take advantage of this entire cycle. And when we reach the pricing stage is when we'll think about whether we should take some money off the table. At this moment in time, we stay invested.
Right. So, which means that you will also be bullish on cement. We are building roads, we are building houses, and we are building lots of infrastructure. So, I think cement must be one of your favorite themes.
Yes, indeed. I think cement, we have... So, the way we look at cement is that we look at the whole cement and building materials as one piece. Cement obviously has two legs, the infra and the housing, and then building materials, mostly housing. So on the core theme, we are quite bullish. The way we, of course, there are certain names where we don't have so much, so much comfort on the valuations, but at the same point in time, among the cement names, ACC, we have Dalmia Bharat in there. But what we've also done is to play specifically the housing theme within that. We also have some building materials. So Somani Ceramics is the one I think we have introduced in our bond portfolio. So yes, we are indeed positive on that.
Right. So my next question is, how is the energy space looking at? Because green energy is catching up, oil prices are fluctuating. How would you look at the energy space?
See, in the very short term, of course, there has been a positivity because of falling oil prices. Demand definitely has disappointed, and I don't know if it was yesterday or day before, but if you see the situation on inventory in the United States, it's a lot more than we thought. That seems to suggest two things. One is that the shortage of oil globally is not as stark as we thought it was. And the other is that the demand doesn't seem to be flowing through as strongly. Now, this scenario typically tends to be good for India. Now, 26th, I think there is the OPEC meeting. Likelihood the cuts will continue, but it looks like there seems to be, despite all the two wars which are going on, there seems to have the oil prices have gone up and down, but generally are not catching fire, so as to speak. In that type of scenario, it's better for the oil marketing companies. Indian Oil is there as an overweight position for us. To play that, we have a neutralish kind of view on ONGC. But the way in which we are doing this is that, one of the ways we are trying to position our portfolio is also to look at structural themes which go beyond the entire volatility which will happen in the market. So if you look at the two big themes, one is the shift from more polluting, energy sources to less polluting energy sources, and moving on to green. Now, there's no obvious way to play green hydrogen, for example, or green energy, but what we have quite heavily overweight out of benchmark positions in our model portfolio are basically the gas names, which seems to be a nice kind of interim mezzanine kind of step to move towards a completely green economy. So GAIL, Indraprasth, Gujarat Gas are there in our model portfolio, and we are playing that theme using that. So energy as a whole, we are underweight because of our underweight position tactically on Reliance, but I think it's really a conglomerate more than anything. But because it sits in the index in the energy basket, we are underweight energy, but we are overweight on the gas names and the OMC, one OMC.
Right. So One other sector, this is something which has been happening for the last 6 months, the FMCG sector, the FMCG segment.
Mm,
There's not been much
mm,
movement, except for
mm,
ITC. If I'm not wrong, ITC has gone up to 450, 460, and it's still hovering around that. How would you view
mm.
the FMCG sector at this stage?
Look, we used to be very underweight because of valuations. We are less underweight, but we are quite underweight. Even now, I think we have a 500 basis points underweight position on a relative basis in FMCG. Uh, Everything is underweight. We used to love ITC back in the day, but then the stocks really rallied, so we've cut that a little bit as well. The only kind of FMCG name, if I may call it that, which we have in our model portfolio is again off benchmark, which is United Spirits. And so also similarly, if I extend that argument even in the consumer discretionary, we have the same view. I think in this kind of market, when with so many uncertainties, market already at 19,700, maybe more than a standard deviation above. We believe that we don't have as much comfort on valuations. It's a call which has worked well over the last year and a half, 2 years. At this point in time, we are less negative than before, but we continue to remain negative. So FMCG is not a space that we are very positive on at this time.
Okay, one last question and an important sector at that. Autos. How do you view autos? Are you overweight on the passenger vehicle side or on the truck, if at all it's part of your portfolio?
Yeah, so in autos, in the OEM, we have only two names. We have Mahindra, which is an equal weight, 150 bips, and basically Maruti. Maruti is a slight overweight. You would say a little bit of consumerish kind of theme in there, upgradation theme in there, and on Mahindra, it's rural tractors and so on and so forth. So again, not as much comfort on the auto space. So if you look at the entire portfolio, we are quite underweight.
Right.
But within that, we have, I think there are 6 or 7 names in the index from the autos, broad auto space. We have only 2, which are basically Maruti and Mahindra. The rest are all at 0 weight at this point.
Okay, so let me wrap this conversation with one question. Will you keep or stay in cash the incremental inflows and wait for clarity, or will you say I will keep deploying as and when the money comes and not sit on cash?
No. So that's an easy one.
Okay.
We are equity analysts. I think the question is, we don't, as a house, we never go over 5% cash. We have 3% cash at this moment in time. We'll be on 3% cash.
Okay.
Money has to be invested. I think we try not to time the market at all, ever.
Right.
We believe in the long term. We'll get 12% type returns on the market if what our expectation on GDP etc. is. We are not going to use. We might stagger it through the month or something like that, but at the same point in time on the model portfolio, we do not go over 5% cash ever, and we don't advise any investors to ever do that.
Right. So it's 12% is what you're looking at in the long term, or are you revising that target?
This is. Yeah. No. So look, it's a long-term kind of growth estimate basis, GDP and all of that.
Yeah.
Because you'll have 7% GDP, 4-5%, that gets you to nominal GDP of 10%. Let's say you get 1.2 times.
Right.
So that's how we get to 12.
Right.
Now it's come off. When I started my career, this used to be 16-18%. It's come down to 12. This is my view. This is not so much. At this moment in time, we don't have as much comfort on the valuation. So will we get 12%? I'll be very happy if we get 12% return in the market in the next 12 months. We are not in that camp. We are in the single digit camp at this, and single digit means plus or minus 5%. So we believe the market kind of in that sense will go up and down, but broadly remain in this range. But yes, long term, we believe that you will make money. Also, we genuinely believe even this year that if you can pick your stocks well, if you can buy companies where earnings are going to get delivered, the premium multiples for companies delivering earnings will stick.
Right.
It's a strong view. We do not believe that market is going to have is coming off a cliff or a dislocation is happening. That is not our view.
Sure.
So in that sense, you can pick good stocks and continue to make money in the markets. We don't see any problem with that.
Okay, Unmesh, thank you so much. Stock picking is the right way to go, as Unmesh points out. Thanks again for joining BQ Prime.
Thank you very much.